So let's talk about the recent volatility we've seen in financial markets, what's driving it, where things could go from here. And of course, we'll take a look at the US dollar as well as the tech-heavy NASDAQ as we see some potentially interesting trends playing out. Okay, well, it all starts with bond yields in the United States in particular. And, well, there's been several factors driving them recently. If we go through the list one by one, and in no particular order, funding pressures in the United States, we know that the US is running some fairly significant fiscal deficits. There was also some indigestion, we'll call it, especially following the government shutdown this year in the States, which meant there was a build-up in supply or issuance in the market, I should say, which increased the supply of treasuries and put upward pressure on yields. But we're also seeing some other dynamics play out. Bank of Japan stepping away from its yield curve control, maybe moving money back into Japanese government bonds and away from treasuries. Also reportedly too that perhaps China is stepping away from buying treasuries so heavily, mostly because of political reasons, although that that issue there is an open question. But perhaps the biggest issue of all, at least what's moving markets recently, is signs that the US economy is incredibly resilient. So going back through the chain of events just this week, we've had two very major releases suggesting that maybe not only is the US economy proving resilient, but could even be re-accelerating. So job vacancy data at the start of the week showed an unexpected jump in job openings, suggesting that maybe some of that tightness in the labour market is continuing. That's a risk for upward pressure on wage growth and inflation. And then we also saw a slew of data that suggested that manufacturing activity could even be picking up in the United States, which in part is a good thing in the sense that it's still, as far as the ISM manufacturing PMI figure goes, showing that there is a slowdown, a contractionary environment in manufacturing. However, those folks calling a recession at the start of the year, which was basically the consensus view for market participants, one indicator that those people would often look at, or market participants generally would often look at, is the headline level of the ISM manufacturing survey. In the past, it has led the economic cycle reasonably well. When the ISM manufacturing survey does drop below 45, it's a very clear harbinger of recession. Although we have seen the ISM manufacturing index fall into contractionary territory and remain in contractionary territory for some time, suggesting a slowdown in the US economy, and then it bottoms at that sort of sub 45 level, which again is typical of a recession, a looming recession in the United States. And the fact that we're seeing that index starting to rebound now points to a resilience in the US economy. Now, you put all of this together, again, the strong data, the prospect that maybe growth will accelerate. And as a bit of an aside, if you do look at the Atlanta Fed GDP nowcast, which is effectively a day-by-day indicator of what the next quarter's GDP will be, it's indicating potential growth of 4 to 5%, which is absolutely extraordinary given the high interest rate environment. So that you throw in the fact that off the back of Jackson Hole, the Fed was very clear that it thinks that rates could stay above 5% for much of next year, and maybe there might even be another rate hike in the Fed before the end of the year. This has led to this cascade of selling in the bond market. So when that happens, obviously bond prices work in an inverse relationship with yields. Bond prices fall, yields go up. That has a number of effects. One of those is it compresses equity valuations, so multiples start to decline. And it also raises the concern potentially of slower growth in the future as financial conditions start to tighten in response to, again, this sort of resilient economic data. So there's a couple of factors there that can really weigh on equity prices. The flip side of that, with everything basically selling off, gold is another one there too, which is highly correlated to bond yields, is that the US dollar tends to surge. And we had seen a steady strengthening of the greenback for, well, most of this year, or at least the last 6 months ago, let's call it that. But it's really accelerated over the last couple of weeks, especially after the ECB flagged that it expects that maybe this is the peak in interest rates in Europe. The UK lent, or the Bank of England lent on some fairly weak CPI figures recently to suggest that maybe they're at sufficiently restrictive policy settings and won't have to raise any further. And then, well, we have to speak too about the Japanese yen, with the BOJ very reluctant to let yields fly higher in any kind of rapid way, and is continuing to try and lean on the 10-year there, which climbed to about 0.75% during the week, which is as high as it's been in the last 10 years. We had the the Japanese government intervening there actually, or probably intervening there during the week to try and lean against a stronger greenback or weaker yen. It all seems a lesson in futility. That 150 level is very interesting to watch. But again, all of these factors are feeding into a stronger greenback. US, the strongest economy out there, as well as maybe this kind of risk aversion that sort of feeds the US dollar as well. So as we look ahead now, well, we've got a few significant overhead risks over the next, week or so. US non-farm payrolls data is probably the most significant. If it starts to reaffirm that jobs growth is picking up there again, that maybe wage pressures are proving to be persistent, then that's really a factor that will drive expectations for another rate hike before the end of the year from the Fed, drive those expectations higher, and also consolidate that view potentially that the federal funds rate could indeed stay above 5% for, longer than anyone previously expected. So let's discuss the US dollar and the way it's shaping up. And it's best to look at the US dollar index. Of course, we could jump into a number of pairs. The euro is obviously effectively just an inverse US dollar index, given its weighting in the overall index there. And we effectively could look at any currency pair at the moment. It would be very, very similar depending on your risk appetite, your desire for, I suppose different thematic plays and what have you. But let's start with the dollar index because it tells the story of the dollar's trend at the moment. As you can see, it's very difficult to argue that the US dollar is not in something of a primary uptrend. We did see a lot of weakness coming through at the start of the year, and a lot of that was by virtue of the fact that the dollar was very overbought. So there was an unwinding there, especially when sentiment reversed around the AI trade at the start of the year, which kind of catalyzed a little bit of risk appetite and maybe a little bit of repositioning into risk assets through the market. But let's just have a look at where we are here and now in this moment, and we can see here a clear trend channel has emerged for the greenback. Over the last couple of sessions, we have seen something of a pullback, that kind of drop in oil prices, which brought yields back, and therefore the US dollar as well took a lot of pressure off markets. But you can see traders are really buying the dip into the greenback to the dollar index, the 10-day moving average effectively being a level of support, if nothing else, an indicator that that it might be a desirable zone for the bulls to buy into dollar weakness. And we've got here, of course, too, that sort of lower bound of the trend channel, which might act as some level of support. The most recent higher high here was just shy of 107 on our charts. Perhaps if you do look at the dollar index across some other platforms, you might see that it's say Bloomberg price, for example, you might see that the price was a little bit higher. But just in terms of our price here, just selling off below that 107 level. What would we have to see to negate that bullish view for the US dollar? We probably have to start to see this trend start to break down, and maybe a push below 105.50, 105 at the most extreme to sort of suggest that, okay, the bulls have lost control of the price and maybe the sellers are starting to come through. But if we continue to see strong data in the United States, and at the moment, it does look like the US economy is certainly in a position of outperformance against the rest of the world, that uptrend is likely to remain intact. It's all data dependent, of course. The Fed keeps telling us we have to obviously continue to try respect that data and what it would potentially mean for Fed policy. But nevertheless, a bullish trend there for the US dollar. And further strength and signs of resilience in the US economy is more than likely, or probably, going to continue to feed this uptrend. Okay, let's just take a look now at the NASDAQ as well. This is important clearly because it's probably, it is of the major US indices the most yield sensitive. Why is that? Well, it's obviously comprised full of tech stocks. These tech stocks are typically growth stocks, and those growth stocks tend to be sensitive to yields at the long end of the curve, obviously because of the cash flows that they're expected to generate and grow out further into the future. So their multiples get compressed, their stock valuations go down, the index, or the NASDAQ index, goes down. The S&P 500 does as well, but of course NASDAQ is a much more pure tech play. Let's just go through a few technical indicators that we're seeing here, and a little messy, it has to be said, but let's identify some of those key levels in the short term. First and foremost, we're seeing some fairly significant buying support coming through. 14,400, there's a buying zone. You can see there's a support zone for the index, which has sort of represented inflection points, reversal points in the past. In saying that though, we're seeing the uptrend of most of this year, and we spoke a little earlier about the AI boom and the kind of bullishness that generated in the market. That sort of uptrend has broken down over the last couple of months, and we're seeing what is effectively a range-bound market for now. No signs yet that the trend is to the downside, but certainly you can identify through here just a pattern of lower highs, not yet a clear indication of lower lows. But nevertheless, momentum is looking skewed to the downside, or at least is suggesting some level of consolidation. And you can see that the RSI, the daily RSI, is below 50, which does suggest that upward momentum is, well, scarce to say the least. But major level at 14,400, if we do continue to see yields rise, let's say the 10-year hits 5%, well, you start to question whether the NASDAQ can hold on to those sorts of levels. We have seen over the last few days a pullback in yields. Again, thank you very much, OPEC, and that 5% drop in oil. The short-term levels to watch here, 14,800 is key in the very short term. If that happens to break, well, it opens up a bit of a reversion to some of those key moving averages. There also seems to be some support resistance in the past at, we'll call it 15,200, although it's slightly higher than that. Really, once again, this is going to be a yield story. It's going to be about whether the data continues to come in strong and raise fears about further monetary policy tightening in the US. If that continues to happen, risk might be skewed to the downside for the NASDAQ. If that starts to subside and we start to see buyers coming through into the bond market, that will lead to that kind of, well, favorable tailwinds to multiples for tech stocks. And we could start to see this sort of basing pattern turn into maybe a move higher. So there you go, a fairly dynamic situation to say the least. It all starts with US data. It all starts with expectations around the Fed. It all starts with what is happening in bond yields, and the trends in the market for the time being are likely to be driven by that. So keep an eye on things. Non-farm payrolls will be the next major data release to cap off the week to keep an eye out for.